SPCX post-IPO, short squeeze potential versus lockup reality. The historic June 12, 2026, initial public offering, IPO, of SpaceX, $SPCX, on the Nasdaq captured the financial world's attention, completing the largest IPO in history by raising $75 billion at a baseline price of $135 per share. In the euphoric days immediately following its debut, the equity gapped to an all-time intraday high of $225.64, pushing its market capitalization past $2.6 trillion and briefly making CEO Elon Musk the world's first trillionaire. Gravity has since caught up with the stock. Following a series of technical headwinds, including the July 16 automated launch pad aboard a Flight 13 Starship V3 configuration, which then slipped from a planned July 20 attempt to a current target of Thursday, July 23, the stock broke below its IPO price, closing the week of July 17, 2026 at $123.99. That roughly 45% retracement from peak valuation has attracted an unprecedented wave of institutional short selling, and pulled the $135 offer price back into focus as a psychological line in its own right. Note, all price, short interest, and borrow fee figures in this piece reflect data as of July 17 to 19, 2026. Given how fast these numbers have been moving, readers should check for more current data before relying on them. What follows pulls together two things: the mechanical case for why the setup between now and the August lockups could get volatile in either direction, and what the actual analyst and lockup data supports once checked against primary sources, since some of the more dramatic framing in circulation, Widowmaker, trap, orchestrated, price defense, overstates what the record actually shows. 1. The anatomy of the bear thesis. Short interest in $SPCX has climbed sharply, with reported short positions representing a substantial aggregate bet against the company, among the largest absolute short accumulations against a newly listed equity on record. As of July 17, 2026, S3 Partners data, reported by CNBC, put short interest at roughly 185 million shares, or 29% of the publicly tradable float, representing about $25 billion in short positions, up from just 13% of float 3 weeks earlier. That figure has moved by several percentage points week to week. Other trackers, such as Ortex, have shown readings between 28% and 31% on different days in July, so it's worth checking for a more current read before treating 29% as fixed. The short thesis rests on 3 variables. The valuation disconnect. At the July 17, 2026 close of $123.99 per share, the company carried a market capitalization of roughly $1.6 trillion. Bears argue the stock prices in highly speculative revenue lines, orbital data centers and AI infrastructure via the XAI segment, well ahead of proven profitability in those areas. Short sellers leaning on conservative sum-of-the-parts models to make this case is a reasonable characterization of the bear thesis in general, though any specific per-share SOTP figure circulating in commentary should be treated as illustrative modeling rather than a sourced institutional estimate unless it's directly attributed. The post-IPO float expansion. Less than 5% of SpaceX's total share capital was floated at the IPO. Initial lockup expirations for insiders, venture backers, and employees begin 2 trading days after the company's first quarterly earnings release, expected in early August 2026. That first tranche unlocks roughly 911.5 million shares, about 20% of the insider block, with additional tranches following through the rest of the year. Independently confirmed estimates, 22V Research, via Trading Key and Yahoo Finance, put the cumulative total across the August-September window at up to 44% of shares potentially eligible for sale. The low carrying cost. Despite the size of the short position, the annualized stock borrow fee has reportedly remained low, around 1% per Morningstar/S3 Partners data as of mid-July 2026, though other trackers have shown it slightly higher, around 1.37% on a given day per one short interest tracking site, so treat the exact figure as a snapshot rather than a fixed rate. This reflects an abundant supply of lendable shares from long-term institutional holders, index funds, sovereign wealth funds, early VCs, who have no near-term intention of selling and are willing to lend for passive yield, not a signal that the market has already priced in, or dismissed, the risk of a squeeze. Borrow fee data of this kind is largely uninformative about a future, catalyst-dependent event. It mainly describes present conditions, not what happens after a binary catalyst resolves. Two, why cheap borrow doesn't mean a safe short. To understand the risk bears are exposed to, it helps to look at why the borrow fee is low despite heavy short demand. When a trader shorts a stock, they borrow shares from long-term holders, index funds, ETFs, sovereign wealth vehicles, whose lending desks are often happy to supply inventory for incremental yield, since they have no plans to sell. That abundant supply keeps fees low. It doesn't, however, guarantee the supply stays abundant. If a long-term holder needs its shares back, to sell into an upcoming window, or to hold voting rights ahead of a contentious vote, it can recall them. Under Reg SHO Rule 204, the short seller then has a limited window to find a replacement share. If the broader lendable pool has also tightened at the same time, brokers can be forced into mandatory open market buy-ins. Importantly, none of this requires coordination. There's no evidence, and no need to assume, that institutional lenders are acting in concert or deliberately targeting short sellers. That would raise real securities law questions and isn't something the public record supports. What's plausible instead is that many separate lenders, all working from the same public lockup calendar and the same public short interest data, could independently choose to recall shares around the same window for their own unrelated reasons, needing custody to sell, wanting voting control before earnings. Actions that look synchronized from the outside can emerge from ordinary, self-interested decisions made in parallel, a distinction that matters both for accuracy and because true coordination would be a different, legally fraught story. This is also where a similar overreach shows up in some coverage of the $135 line itself, the claim that underwriters orchestrate massive block buying programs to defend the offer price implies active, coordinated price defense that isn't documented. What is real and disclosed is that underwriters typically hold a greenshoe, over-allotment, option and other standard post-IPO stabilization tools, mechanisms that exist to support the offer price under normal circumstances, not evidence of an active, ongoing defense operation specific to SpaceX. 3. The timing question. Bears are counting on the roughly 911.5 million share unlock in early August to add enough supply to pressure the stock down. What the timing highlights, though, is that insiders can't sell shares on the open market while those shares are out on loan to short sellers. To sell into the unlock, holders would first need to pull any loaned shares back into their own accounts. If a meaningful number of holders do this in the days before the unlock, the pool of lendable shares could tighten noticeably in that window, a period when the newly unlocked shares aren't tradable yet, but existing loan supply is shrinking. If it happens, this could create upward pressure on the stock independent of the later share dump. Whether it happens at meaningful scale, and how much price impact it produces, isn't something that can be established in advance. It's a plausible mechanism, not a documented event. Four, the price contingent second tranche. The lockup structure adds a further wrinkle. A second tranche of roughly 455.8 million shares only unlocks if the stock holds above $175.50 for a specified window heading into the August earnings release. This creates an interesting incentive alignment worth naming plainly, without overstating it. If the price does spike toward and past $175.50, whether from a positive catalyst, from lending-related tightness, or both, it would trigger the second unlock, giving more holders a liquid window to sell at higher prices. That's a real structural feature of the deal. It is not evidence that anyone is engineering the spike to happen, it simply means that if a spike occurs for any reason, more supply becomes eligible to hit the market afterward. Zooming out, lockup expiration itself doesn't guarantee insider selling either. Whether insiders actually sell into these windows depends on their own read of price versus intrinsic value at the time. If the market absorbs early insider selling without much price impact, or insiders hold rather than sell, that would signal underlying demand strength rather than the supply glut bears are pricing in. '5. The binary catalyst, Flight 13. This setup is sensitive to a near-term, discrete event, the Flight 13 launch, currently targeted for Thursday, July 23, a date that has already slipped twice, from July 16 to July 20 to July 23, and could move again. The stock's history shows it's capable of large moves in short windows. It ran from a $135 IPO price to over $225 within days of listing. A successful flight would address near-term concerns about vehicle reliability and could plausibly send the stock back through $135, a level that also carries a meaningful concentration of trading volume since the June listing, putting recent short positions underwater and potentially triggering stop-loss-driven buying. Launch outcome. Operational result. Plausible market reaction. Flawless success. Rapid recycle verified, satellites deployed. Removes a near-term bear argument, could pressure short positions and encourage some early share recalls. Minor abort/pad scrub. Vehicle safe, minor fix needed. Sentiment likely stays frozen, stock plausibly stays range-bound in the low $120s. Catastrophic failure. Pad damage or FAA mishap investigation. Extends the launch timeline past the lockup window, removes much of the incentive for early recalls, likely bearish. Only one of these three outcomes points toward the squeeze scenario. The other two either leave the stock roughly where it is or push it lower, a useful reminder that the mechanism described here is conditional, not inevitable. 6. What Wall Street analysts are actually saying. Separate from the lockup mechanics, some of the sharpest disagreement about $SPCX shows up in analyst price targets, and this is worth grounding carefully, since coverage of it is easy to oversimplify in either direction. Verified, current figures. Morgan Stanley's Adam Jonas set a $300 base case target, buy/overweight, explicitly bundled with a $75 bear case and $600 bull case, a spread the bank itself described as intentionally wide given genuine uncertainty. Goldman Sachs' Eric Sheridan set $205, buy. Needham's Ryan Kuntz initiated at $200, buy, on July 7 and raised the target to $250 on July 15, citing Grok 4.5 and the upcoming Flight 13 mission. CFRA's Keith Snyder set a $115 target with a sell rating on June 12, the day of the IPO. Aggregated data, tip ranks, as of mid to late July 2026, shows the broader coverage universe, 28+ analysts, breaks down to roughly 23 buys, 4 holds, and 1 sell, with targets ranging from $115, CFRA, the low, to $800, Raymond James, the high, and a consensus average in the low to mid $200s. As with the short interest figures above, this consensus will keep shifting as more analysts initiate or revise coverage, so treat it as a point-in-time read rather than a fixed number. The accurate takeaway: Wall Street is not unanimously bullish, but it is skewed heavily bullish, with a small number of genuine hold/sell outliers at the low end, CFRA and, per some reporting, a hold from MoffettNathanson's Julie Zhu at $131, unconfirmed independently here, though not implausible given the other names checked out. A $115 to $800 spread is itself a meaningful, real signal. It reflects just how unresolved the underlying valuation debate is, without needing added drama. 7. A real-world parallel, SK Hynix and leverage-driven dislocation. A useful, current illustration of how quickly market structure, rather than fundamentals, can move a stock is SK Hynix's Nasdaq listing earlier this month. On July 10, 2026, SK Hynix, already listed on the Kospi, began trading American depository receipts on Nasdaq at $149, raising roughly $26.5 billion in the second-largest U.S. listing in history after SpaceX's. The ADRs popped as much as 14% on debut. Within days, the stock reversed sharply. SK Hynix's Korea-listed shares fell 15.4% on July 13, the worst single day in the company's history, and the sell-off spread to its Nasdaq-listed ADRs and to U.S. peers including Micron, SanDisk, Western Digital, and Seagate, before rippling further into the broader semiconductor complex over the following days. Notably, the Bank of Korea stated publicly that the underlying memory shortage and AI-driven demand supercycle were unchanged. The move wasn't a reassessment of fundamentals, it was a market structure event. A significant driver was leverage. South Korean regulators had approved single-stock leveraged ETFs specifically to keep retail investors from chasing this kind of exposure offshore, and one Hong Kong-listed 2x leveraged Hynix ETF swelled to more than $17 billion in assets before collapsing roughly 70% from its peak within days of the reversal, a magnified version of the same move investors and institutions had piled into on the way up. Regulators, including the governor of Korea's Financial Supervisory Service, had already flagged concern about this concentration risk before the reversal happened. This isn't a short squeeze in the technical sense used elsewhere in this piece, it's closer to a mirror image dynamic, where leveraged long positions rather than leveraged short positions were the ones forced to unwind. But it's directly relevant as a real-time example of the underlying principle, when institutions and leveraged traders see a fast, structural opportunity to make money, whether by piling into a hot listing on debut or by exploiting a stock loan or lockup mechanic, the resulting price action can be sharp, largely disconnected from a company's actual fundamentals, and can spill over into peers and adjacent markets well beyond the original stock. The SPCX setup described above carries the same basic risk in the opposite direction, a mechanical, leverage and structure-driven move triggered by short covering and lockup dynamics rather than by any change in SpaceX's underlying business. A note on timing the signal. It's worth being explicit that borrow fee and lendable float data, the clearest evidence that the recall-driven mechanism above is actually playing out, are confirmatory rather than predictive. If recalls do tighten supply and push the price up, fees will rise and lendable float will visibly shrink, but typically only after the associated price move has already largely happened. There isn't a version of this mechanism that offers a clean early warning signal from the lending market itself. Anyone trying to act ahead of this would be making a bet on the launch outcome, or reading options positioning ahead of it, not reading securities lending data, which tells the story after the fact. It's also worth noting the launch date itself has already moved twice in the past week, a reminder that even the known catalyst date in this setup is not fixed until it actually happens. Conclusion: a real setup, not a guaranteed outcome. The bears may still be right that $SPCX is overvalued relative to near-term financials, and the August-September unlocks could add real selling pressure once they clear. Up to 44% of shares are potentially eligible for sale in that window, a genuinely large figure. But the mechanics above suggest the path between now and then isn't guaranteed to be smooth for short sellers either. Cheap borrow today doesn't ensure cheap borrow through a binary catalyst and a lockup event happening close together, and $135 remains a real line with a meaningful volume concentration behind it. The SK Hynix episode from earlier this month is a useful reminder that these structure-driven moves are not hypothetical, they're playing out in real time elsewhere in the market, in the opposite direction, right now. That said, this is a conditional scenario resting on an event that hasn't resolved yet, not a mechanical certainty. Calling it a widowmaker that inevitably springs, or framing $135 as a line under active coordinated defense, both overstate what the public facts currently support. The more accurate framing, this is a real, non-trivial setup with credible mechanics behind it, an unresolved analyst debate spanning $115 to $800, a genuine lockup supply event, and a binary launch catalyst whose date itself keeps moving, not a foregone conclusion in either direction. This piece is intended as market commentary and analysis, not investment advice. Short selling, lockup dynamics, securities lending, and analyst price targets all involve significant uncertainty and risk, and this piece is not a substitute for guidance from a licensed financial professional. References: